All right, let's get back to the market action where we have things lower here across the board. Want to bring in Tom Essaye of the Sevens Report Research, along with Brian Sozzi and Jared Blickery. Good morning to you all. And Tom, I'm going to start with you. What has got investors hot and bothered this morning? We're seeing this pullback, even though we're seeing a drop in the number of Americans applying for unemployment benefits this past week.
Yeah, I think that number one, this is sort of a continuation of the process that began last week, where the market has run a long way, right? And now there's sort of some conflicting data on what's happening with the coronavirus. There's some confusion on growth. But I think if there were one specific issue this morning, it would be the jobless claims came in higher than expected. And we really need the labor market to return to some semblance of normal within the coming months. And this is definitely a little bit of a step backwards.
Tom, do you think the market is at risk of a correction here pretty soon, simply out of fear of the market losing confidence in the Trump administration? Certainly, you've seen the revelations from John Bolton's book this morning. I mean, they're striking. It's just shocking stuff, even for an administration that in many respects has been running chaos since the president came into office. Are you concerned about increasing political risk here?
I'm getting concerned that the market is underappreciating the risk that Trump loses. I mean, the revelations, the ex-administration officials that come out and sort of these crazy claims and things like that. I mean, to a point, I think investors are getting a little bit numb to them because every time we think it can't get any weirder, it gets more weird. But at the same time, the big issue from a market standpoint is the election. And that has to do with taxes. You know, if Biden wins, you can expect that the corporate tax environment will get less favorable. That's bad for earnings. That's a headwind on markets. So I do think that there is general political risk. I think that we have to get closer to November before it really begins to push on stocks, though.
All right, I want to head over to Jared Blickery, 3 minutes into the trading day. And what are you seeing leading us lower this morning, Jared?
Well, I'll tell you what's in the green. We got some tech stocks, some of the FANG stocks, although Alphabet and Facebook underwater here. Sorting by performance, we can see some of the defensive names since the COVID sell-off in the green. Tesla, Zoom, then we got some biotech names also as well. But to the downside, Biogen is actually leading to the downside. That's down 6%, just lost a patent dispute with Mylan. Mylan, not shown here, is up about the same amount, 6 or 7%. And then travel stocks really just getting hit hard. Once again, we can see the cruise lines like Carnival down about 4%, United down about 3%. Software is doing well, though. That has been a safe haven. Microsoft up about 0.5% along with Adobe, but not a lot of big outperformers here. We do have options expiration going into tomorrow, and I think that's going to be a big one. It is quadruple witching. There's a lot at stake here, and we're also ending the quarter in another week, and pension funds are said to be having to sell about $75 billion worth of equity versus bonds because of the recent outperformance. Alexis.
Yeah, good point. That should lead to lots of volume for sure in the market. Tom, your thoughts on valuations at the moment in terms of tech? We've got the NASDAQ up about a startling 45% since those March lows. Is it time to start rotating money out of big tech?
You know, I don't think so. Not yet. And not because I think that valuations in tech are compelling. I don't. I mean, by any measure, they're stretched. The problem is, where else are you going to go? Right? Because everything else generally is either more overvalued if you look at something like a utilities or a consumer staples, or depends on a really big rebound in economic growth, let's say financials and industrials. So neither one of those are particularly attractive when you look at them compared to tech, mainly because tech has a secular growth story. And when I say secular, I mean it's not dependent on whether or not the economy recovers. So even though tech is expensive, even though it's stretched, and even though 5 stocks are really driving the S&P 500, I still think you stick with them until there's more economic clarity.
You know, Tom, even outside of tech, as more bad news does pile on the Trump administration, what are those Biden plays? Do you start to put them on, and where would you gravitate to? Just under the expectations, perhaps we don't get that V-shaped recovery that helps the president out, and perhaps he is not reelected.
Yeah, I think that the first place you go is alternative energy. Right. So that's a space that had pretty big tailwinds last year. I think that's somewhere you can go almost immediately, but you may even move out of healthcare into some of those names because healthcare will now become a major topic again. right? Especially if we get a Biden presidency and the Democrats take Congress with the so-called blue wave, which is rising in probability. So I think alternative energy is one of the sectors that you can immediately go to. You can probably start nibbling on that now, just in case.
We're seeing a lot of money, Tom, flow into money market funds. A lot of people still sitting on a lot of cash. What are your clients telling you right now? Are they becoming a little more cautious as we move closer? I mean, it's still months away, but as we move closer to the election and closer to possibly that second wave that Dr. Anthony Fauci keeps warning us about?
It's interesting. To our point earlier in the conversation, none of the advisors we're talking to are really worried about the election yet. And again, if you were to ask me what is the one blind spot in this market right now, it is the election, because we're super focused on coronavirus, we're super focused on growth, but the election is an issue. So I think to me, people making themselves aware of the election's a big deal. If we have an administration change, then all of a sudden things get much less pro-business. And I don't think that people are factoring that in. I do think that advisors are cautious. They are a bit nervous. They've missed a lot of the rally, but they are hesitant to put money to work here. They want to see a further dip.
Tom, you had a very interesting note this morning, as always, but at the end of it, you said, don't fight the federal government. It's that old saying is always, don't fight the Fed, but don't fight the federal government. What do you mean by that?
Well, it's not just don't fight the Fed, right? Because, in previous times, pre-pandemic, it would be the Fed that would be stimulating the economy. So it was don't fight the Fed. Well, now it's Congress that's also stimulating the economy in a big, big way. And now we're all zeroing in on what, coronavirus stimulus plan number 4 is going to be. So it's not just don't fight the Fed, but don't fight the federal government, because they're also stimulating the economy. And to that point, does that mean you run out and you just put everything in stocks right now? Of course not. But you have to consider all the stimulus out there, even though economic data is bad, and it is a long-term tailwind, no question.
Tom, a little off topic here with the markets, but would love to get your thoughts on this. We all want to see sports come back. We need that diversion in our country, perhaps now more than ever. MLB might not happen. There may not be any baseball. And now this morning, Dr. Anthony Fauci, in an interview with CNN, said there might not be any football. He says unless football players can really live in a bubble and be tested every day, he doesn't see how football in the fall comes back, especially with the threat of a second wave. If we don't have major sports come back, what kind of an effect does that have on the overall economy? And I guess I'm really zeroing in on what does that mean for sponsorship dollars?
Tremendously negative, honestly, tremendously negative impact. I mean, if we think about the huge amount of money that goes into sponsorships of professional athletic teams, not just professional, but also collegiate, right? So think about college football. I mean, there are very interesting papers that if there is not college football this season, then you're going to have a whole lot of universities essentially bankrupt, because they rely on that revenue essentially to fund their athletic departments and other parts of the university. I think that there is a big negative consequence if we don't have sports in some form of normal. Are we going to have 100,000 people watching a football game this fall? No, of course not. But there has to be some sort of middle ground between, I think, what Fauci is saying, which is the medical science, look, this will lead to a spread, and then the economic reality of how much money sports injects into local economies.
It is that fine, high wire balancing act we're all trying to walk right now. Tom Essaye, founder of Sevens Research Report. Thanks as always.
Thank you, guys. Have a great day.
Hey, investors. Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.